credit. We decided to show you. Look at cash here. Cash. Look at what increases cash there on the left side. Any investment increases cash, right? Any services earned increases cash. Any collection of accounts receivable increases the cash, right? So that's why all increases on the left side. On the other side, on the right side, any decreases on cash. Anytime you buy something, what happened, right? The cash is decreased. You purchase equipment, you pay rent, you pay salary, you pay an accounts payable, the owner withdraws, that decreases cash. Okay? So the increase and decrease of cash, automatically, of course, whatever be the difference will be your balance of cash. Okay? That's only a sample of a transaction. Okay? Oh gosh. Go Guam, huh?
And you start on one of it.
Okay. I'm just trying to show you how the journal looks like. Remember, I was drawing in the board, right? This is like the journal, okay? When you record a journal, it looks like that one, yeah? See, general journal, this one. It's just the date, description, and the posting reference, debit, credit, okay?
What is the posting?
Posting reference is where it is coming from. So when you say here, you put GL 101, meaning to say, what is the GL code 101? It could be cash. That means if you review the transaction is coming from that G1. In other words, it's a reference link.
Is it like a universal, or is it different with each company?
It's universal, but although the numbers may change, that's why I'm trying to tell you, all cash are under one. Because the company does not say 101 for Adriana Lopez is the same as 101 for a certain company. As long as you have a synchronized like 101, 102, 104, it depends on the companies. As long as you said that all ones are all assets, 2 are all liabilities, 8 equity, 3, 4 is income account, 5, 6, 7, 8, 9, 10 are all expenses.
Okay.
That's it. Okay? Even in GovGuam, even in federal accounting, they also have a code. Even in GovGuam accounting, they also have a code. So it's universally treated to be that way.
Okay.
So even if you use any software like QuickBooks accounting, it automatically tells you there you want a GL code. And it shows there the GL code, it pops up. All ones are all assets. 2 liabilities, 3 equity, 4 income, 5, 6, 7, 8 expenses.
What does GL stand for?
General ledger, I'm sorry. General ledger, okay? Okay, so, oh my gosh, we have to study debit credit now, huh? Not yet. I don't want to start it because the rest are not here yet. It's kind of hard. I'll be repeating the same scenario.
Well, I'm recording it. They can get a copy.
You're recording it?
Yeah.
Oh, okay, they can give you a copy.
I'll give them a copy.
Oh, wow. It's so nice, huh? They're so nice. Okay, but we need to go to the PowerPoint what it says debit credit. Okay, hold on. This the book gives you that. I think the book in chapter 2 gave you what is debit, what is credit. Is it not?
Yeah, it says something about like debit on the left side.
It's on the left side on debit and a credit.
Yeah.
What's the left? What's the right? Okay. Hold on, huh? I think it is. Is that chapter 2? Hold on. This is transactions. Okay. I think in chapter 3. I have a good PowerPoint that shows what the debit credit is.
Oh, it was chapter 3. The account and rules of debit and credit?
Yeah, is it in chapter 3?
Yeah.
But in the book, but not in the PowerPoint.
Oh yeah, the PowerPoint's one of
The PowerPoint does not coincide with the chapter though. You
Okay.
notice that? It doesn't match with the book itself. That's why I'm kind of hard with this new book because it doesn't. Oh, where are you? Where are you? Where are you? Oh, he's recording it, and where are you? Oh, okay. Well, I'm trying to find. Okay, look at this. Okay, hold on. Okay. Okay, so the rule of debit and credit. Okay. Debit and credit, okay? Remember we talk about account, right? When you say account, it could be cash, it could be any other asset, liability, owner's equity, okay? So when it is written as T because for some reason they call it T account. T, temporarily T account, okay? So when you start with a debit and credit, a T there represents a ledger account and is a tool used to understand the effects of one or more transactions, okay? So the account should always have a left and the right? Okay, so the left side means debit, the right side means credit, okay? We're not talking about what account are we talking about, right? You know, because it's a different rule, okay? So left, debit, right, credit, okay? Look at this rule. So first of all, you need to identify what account are we talking about, okay? Are we talking about asset account? Are we talking about liabilities account? Are we talking about equity account? Okay? Let's focus on asset. Okay? Asset first. Remember, asset is what you own, right? What you own. You notice that from the equation itself, asset equals liabilities equals owner's equity. If you increase the asset, what does it say? Debit. Right? If you increase the asset. What is the what? But if you increase the liability, you credit. Right? Think about it. Remember the equation, there's an equal sign here. If this is debit, increase on asset, you just to be easy to understand, what do you need to understand first? All the debits, okay? That's the way I look at it. Because when I was studying accounting, I always say, if asset increase is debit, automatic I know that when I decrease an asset, it's a credit, right? Right? So the rule is, all memorize first all the increases. The increases. If I increase the asset, debit. If I increase the liabilities and owner's equity, what does it say? Credit, right? See? Because the equation is, this is the T account. I'm sorry, wrong. See, if I increase this debit, this should be, and the increase here is credit. DR means credit, okay? So, if I say the transaction on October 1st, what is the transaction on October 1st? Let's see. From these exercises, Adriana Lopez. What does it says?
She invested.
Okay. Adriana Lopez invested 55 cash, 20,000 computer system, and 8,000 of office equipment in the company. Remember, our entry here is plus, plus, plus. These are all assets, right? On the other side, it's also a plus, but it's an equity. Can you imagine if these are both debits, it cannot be a double entry, right? So if it's plus for assets, plus here and plus, That means enter credit, it should be debit cash, debit, what's this? Computer supplies, debit equipment, credit capital. You get it? In other words, when there is a debit, there should always be a credit on the other side of the equation. It can never be credit or debit at the same time. But it can also happen that the debit and credit could be on the same asset account. Look at the sample of, what is the next transaction? The company purchased computer supplies on credit from Harris Office Product. Oh, same rule applies because it's the other side of the equation. That's why your entry there is debit, accounts receivable, increase, right? Asset is increased, you debit, right? And then your credit is, what is the credit? Supplies. Is that a credit supplies? Oh, no. Yeah, the credit is liability, payable, increase payable. How do you, it's a liability, you credit. Right? The first thing that you need to know is determine first the account. Okay? You need to identify at this point what are assets, what are liabilities, and owner's equity. All assets when you increase debit. All liabilities and stockholders' equity when you increase credit. But there is an exception later, okay? All expenses. I told you it's kind of hard to learn the debit credit. Okay? The rule.
But why is it different for liability and equity?
Because think about it in a common sense. Where are they located on the equation? If you put a T account here, where is the T account? If you put a T on the debit is on the left, the credit is on the right, right?
Yeah.
So any assets debit increase, any liabilities and stockholders increase credit. You see it? If you draw a T account, if you draw a boundary, a T on the boundary, that's how it is patterned. Okay? Later on, we'll be used to it. So when you that's why it's kind of hard to really study debit and credit. So I want you to really focus on the principle of increase is what you need to know. If asset increase is debit, liabilities and owner's equity increase is credit. Okay? If assets decrease is credit, the opposite of liabilities and owner's equity is debit. Right?
Yeah.
I think
Self-explanatory there.
Good. In the book, it shows there. Page. What? Did you print the book? Because we need to do exercises to understand better rather than. Okay. Did you see it in the book? But I have another.
85?
No, another. There's another one. I only print the one that has. The one that has.
82.
I want you to focus this on the weekend.
Okay. 82. Yeah.
Okay. Okay. If you go to number 5, it said the effects of debit and credits on assets and liabilities and the normal balances, okay? Think about it in the real sense. If cash balance is credit, is it normal?
No.
It's not normal, right? For you, if your cash balance is credit, it's not normal. That means what happened? Your deficit, right? Right?
Yeah.
So,
Oh, that's true.
sure, right?
Yeah.
That's why all assets, usually when you increase it, it's all debit, it's adding.
Yeah.
Add. Because it's abnormal if your equipment asset account is credit. Where is the equipment? It's credit, meaning it's not in the books. Where is it? Where can you find it, right? It's ghost asset? Somebody stole it? No, think about it in the common sense, right? If you're in accounting and you're analyzing asset account, why is it that I have a credit balance on my asset? It's not normal, it's abnormal. Asset should always be debit because assets are what you own, right?
Yeah.
Any increases on asset is debit. Any decreases, of course, is a credit. But of course, your asset, normal ending balance of asset should always be a debit balance. Otherwise, it's an abnormal thing, okay? So look at the number 5. It says, what does it says? Read it, AJ. You're my man now. I keep asking you to read it. Number 5. Oh, no. I didn't give you, I'm sorry. The number 5 rule.
The effects of debit and credit on assets and liabilities on the normal balances are.
Okay? Assets first, okay? So, on the asset, what does it say? Debits. Are you reading number 5?
Yeah.
Okay. On the debit side, it says?
Accounts.
Yeah, on accounts level, yeah. So, you're talking about assets here? It says the debit is increase.
Oh, okay.
The credit is
Decrease.
decrease. Okay? Normal balance, of course, of asset is debit. No? Abnormal if it's credit, right? Okay, on the liability side, what does it say?
Say again?
On the liability, okay? The second one, liability.
She's reading like a cross.
Decrease.
Yeah.
Credit increase. Normal balances.
Yeah. Right? Where is liabilities located on the equation? It's on the right side, right? Right side. So that's why every time you increase a liability, it's a credit. Every time you decrease, it's a debit. Okay? Okay. On the number 7, it shows there how the effects of debits and credit on the owner's equity accounts and the normal balances. Okay. Owner's capital. Every time you decrease an owner's capital, what happens? You credit what? Owner's capital, debits decrease. Of course, increase is credit. Remember, in the owner's capital, every time you increase an owner's capital, where is it located on the equation? On the right side. Right? So every time you increase the one on the right side, it is credit. Every time you increase the one located on the left side, it's debit. You got it?
Yeah.
That's the easy to understand. The only exception that I want to tell you is, I don't know if I'm talking about a sole proprietorship. This is asset, right? Withdrawals and expenses. Oh, these are all debit. When you increase it, it's debit. There's no question on asset. It's a debit when you increase it. Why is withdrawals and expense debit when you increase it? Why is it located in the equation? It's on the right, right? But look, it is minus. This is minus. Right? So, of course, it's the opposite, right? On the owner's equity. Withdrawals is a deduction from your equity.
Yeah.
So every time you decrease it, every time you increase it, it's a debit, right? Because this is minus. This is minus. Okay, there's no such thing as credit expenses. There's no such thing as that. There's always debit expenses because when you increase an expense, that means you're adding up your expenses because later on, you will be deducting that from your equity portion. You got it? So bear in mind about this. Oh, same treatment in corporation. Because withdrawals for corporation is equivalent to what? A loss or something, right? Well, you know, the owner withdraw, but of course the corporation, if there's a loss, it's good. The owners doesn't withdraw in corporation. There's no such thing. So loss is here, right? Here. So that will decrease. Dividends, of course, when you pay, it's an expense for the corporation. The same scenario. But focus on this thing and you won't get lost. Okay?
So those are Those are debits.
It's always debit. Every time you increase this, it's always debit. Okay? Because withdrawals decreases your owner's equity. Expense decreases your owner's equity. So every time you decrease that, even though they're located on the right side of the equation, it should be a debit. Okay? Just think where is it located first. And then determine what account am I talking about. Right?
Okay, yeah.
Because it depends on what account are you talking about. Are you talking about assets? Assets is easy to identify. Right? Liabilities, easy to identify. So if you know the rule of the normal balance rule, if I increase my asset, I will always debit it. If I increase my liabilities and owner's equity, I will always credit it, except withdrawals, expenses, dividends, or retained earnings. Okay? Those things. So, if I know the rule of increase, I should know the rule of decrease later. If I decrease my asset, what's going to happen? Credit.
Credit.
Because I increase debit, right? If I decrease my liability, I will debit. Because normally, the balance is credit. Where are they located?
On the right.
Asset is located on the left, right? So every time you increase the left, it's a debit. Every time you increase the one on the right, which is liabilities and stockholders' equity, you credit. Well, the exception will just apply later, okay? That's the simple rule that I can tell you. It's how you imagine that later when we do solve the problem. We'll solve the problem, this problem, the same problem that I give you, and we will interpret it in a debit credit. Okay, this one that we didn't interpret it debit credit. We only do plus minus, right? When we will do it next week, we'll do the debit credit principle. We'll forget about plus minus now. Okay, so better, what do you call this? This one is a good illustration though, but you have the one in the book though. Can you open the book? It's in page, there's an illustration there about the rule of debit credit. It's in chapter, is it chapter 3? I don't know if it's chapter 3. I was reading it last time. Okay. Using the internet. No. Somebody got it? I didn't print the text. What?
Sorry, I have to go to the bathroom.
There's no food here, so
Oh no, I'm going to the
where's that rule though? I don't know.
chapter 3.
Huh?
We'll just search chapter 3.
Yeah, you read
Yeah.
the chapter 3 and it shows there the rule.
Okay.
But if you want this, actually this one suffice though. Just read this. This one suffice. Sometimes the more materials you have, the more you get confused though. You know what I mean?
Yeah.
The rule is our objective is learning the debit credit. Okay? So I think this one suffice though. You know the effect. The most important thing there, at least more or less you know what are assets, what are liabilities, and owner's equity. Okay? Because if you know how to identify, for example, if I ask you, RJ, is retained earnings what account? Assets, liabilities, and equity. Okay, what is that account? Equity. Oh, every time I increase the equity, what's going to happen?
Credit.
Credit. Right? Credit. Right? It's not of the exception. I'm not saying it's a withdrawal and expenses, right?
Yeah.
Retained earnings is income, right? It increases. Okay. Accounts payable. Okay. I'm not, okay. Davita, accounts payable. What account is accounts payable?
Liability.
Liability. Okay. And when I increase my liability, what do you do?
Increase your liability.
Where is it located, huh? On the right, right? So if I increase the one on the right, what's gonna happen?
Credit.
Credit. Right?
Right.
Right?
Yeah.
Credit. Okay, let's do another one.
Wait, increase.
Accounts receivable.
Accounts receivable.
Okay, let's see, Mike. Let's see, Michael. What's accounts receivable? Asset. Okay. If I increase my accounts receivable, what do? But don't look at the board.
Oh, I thought you.
Don't look at the board.
You're gonna increase, so you're gonna debit, right?
Okay, debit.
Yeah,
Where is it located?
it's on the left side.
Okay. So increase your left side, debit. Right? What account are you? First of all, identify what account are we talking about. Okay? If it's asset, every time you increase an asset, debit. Every time you increase liabilities and owner's equity, credit. Except, I told you, except those things. Because those are withdrawals decreases your equity. So it should be not a credit when you increase it, should be a debit, right? Because it's the exception. Same time with expenses. Okay? Next.
If assets, why is it with assets? Is because you pay for it? Is that what?
No. What do you mean?
Like,
What?
why is asset,
Debit when you
Yeah.
increase it?
yeah, when you increase it?
Every time, why is asset debit when you increase it?
Yeah. Why is that? I forget. what
Because it's addition. I mean, every time you add an asset, it's what you own, right?
Right.
Every time you add an asset, it's what you own. That means you're increasing what you own.
Okay. On this.
For example, if I have so many cash collections for the day, my cash will be increasing, right? So that's adding. But if I keep paying my cash every day without knowing that I don't have any collections on the left, my increase, what's gonna happen? My credits will be more my debits. And it's abnormal for cash to be a credit balance. Remember, can you just imagine you own something and you said it's a credit, meaning?
Well, I'm just wondering there because I understand withdrawals. I expected that would be a minus, right? But then why would the asset be a minus? 'Cause I don't see it- I
Why
don't
will
see-
the asset be debit? Is
Yeah,
that-
yeah. Why would it be a debit if you?
Well, because the rule of accounting is when you say
Well,
increase
debit
in
on this side,
asset,
yes.
increase
But
in
on-
asset is debit and decrease of liabilities and owner's equity is credit. Then double entry bookkeeping. That's what you call double entry.
No, I'm just because I know with assets it's debit when you increase it. I know that, but I was just looking at that, and I thought that it was a minus there. Oh no, it's a check. It's just a check, yeah.
It's
Sorry.
not a check, no.
Okay, because I thought that's what it meant.
No.
Okay.
It's just my.
Okay, so yeah, the withdrawal makes sense.
How about office equipment? Asset, okay? If I increase my office equipment, what is that? Debit, okay? If I sold my office equipment, what's gonna happen?
So,
You sold it.
Credit.
You get cash.
Credit, right? My office
Oh.
equipment will be credit. But if I receive cash at the same time, my cash will be debit and my office equipment will be credit. In a double entry, my entry will be debit cash, credit, office equipment.
Both of them.
Yeah, one is on the left, one is on the right. One is increased, one is decreased. Okay? The entry should always have a debit and the entry should always have a credit. It cannot have all debits without credit. That's double entry bookkeeping. Okay? Okay, I don't want you to get confused. Just look at it and we'll do the exercise again, but we will apply the debit credit, okay?
All right.
I don't want you to get confused. I know this is the hardest part, debit credit. Once you know accounting with debit credit, I don't think we're going to issue.